If you've used your CPF savings to buy a property, you might be in for a surprise when you decide to sell it. Many homeowners don't realize that they need to refund not just the amount they took from CPF, but also the interest it would have earned, and this can take a big chunk out of your cash proceeds. This is called the CPF accrued interest, and if you don't plan ahead, it could throw you off your financial plans. But here's the good news. With the right strategies, you can manage it effectively and avoid any unpleasant surprises. In this video, I'll explain what CPF accrued interest is, why it matters, how you can calculate it, and the steps you can take to reduce or avoid it altogether. Hi, I'm Fer from Dollar Bureau, a personal finance platform that talks about insurance, investments, and financial planning. Okay, so what is the CPF accrued interest and how does it work? When you use your CPF to buy a home, you're essentially borrowing from your future retirement savings. Your CPF ordinary account currently earns about a 2.5% interest per year. If you had left the money in your CPF account instead of using it for housing, it would have been compounding and growing over time. But since you withdrew it to buy a home, CPF considers it as money borrowed from yourself, and the interest that would have been earned still needs to be refunded. This means that when you sell your property, you must pay back the principal amount you took out plus the interest it would have accumulated. For example, if you withdrew about $200,000 from your CPFOA to buy a home and kept the property for 10 years at an interest rate of 2.5%, the CPF accrued interest would be around $56,000. That means when you sell your home, you must refund $256K to your CPF before getting any cash proceeds. Now, you might be wondering, why do you need to repay this money when it is your own CPF savings? While CPF is primarily meant for your retirement and the funds in your CPF accounts help ensure that you have enough money in the future. When you turn 55, your CPF OA and SA will be combined to form your retirement account. This account determines how much you will receive in CPF life payouts, which will provide you with steady lifelong income when you retire. The government requires you to refund the CPF accrued interest so that your savings are not depleted by property purchases. This ensures that when you retire, your CPF balance is restored and you can still receive payouts to support your living expenses. Since accrued interest continues to build over time, it is important to keep track of how much you owe. So, how do I calculate my CPF accrued interest? Calculating this is fairly straightforward. I will leave the formula down here in the video, so make sure to pause to read. So, if you withdrew $200,000 and used it for 10 years, the interest rate would be applied monthly, and over time, it can add up significantly. You don't have to manually track this though. CPF provides an easy way to check the exact amount, which I'll cover later in this video. Now that we understand how to calculate the CPF accrued interest, let's look at how it actually impacts you when selling your home. One of the biggest impacts of the CPF accrued interest is that it reduces the cash proceeds you get from selling your home. After repaying your outstanding mortgage, the next step is to refund CPF before you can take home any cash. If your property hasn't appreciated much in value, you might be left with very little cash from the sale or even none at all. Next, most people think about their home price and loan repayments, but they don't consider the hidden cost of accrued interest. Over time, accrued interest increases the amount you need to refund to CPF, making your home more expensive than you originally expected. While this might sound worrying, there are ways to manage it. Let's go over some strategies to reduce or avoid the CPF accrued interest. Firstly, use cash as much as possible instead of your CPF for monthly repayments. This keeps your CPF savings intact, preventing interest buildup. Secondly, if you have spare cash, you can refund your CPF you use for housing early to reduce the interest accumulation. Next, you can refinance your home loan. Switching to a lower interest rate reduces your mortgage repayments, which in turn reduces how much CPF you need to use. So once you've decided on a strategy, the next step is to check how much CPF interest you currently owe. To check your CPF accrued interest, follow these steps. Regularly checking this can help you plan ahead and avoid surprises when selling your home. Okay, so now what happens to the CPF accrued interest if I pass away? So if you pass away, your CPF accrued interest does not need to be repaid. Instead, your CPF funds, including any unrefunded amounts, will be distributed based on your CPF nomination. To learn more about the CPF nomination, how it works, why it's important, and how to set it up, check out the previous video I did on this. I'll put the link in the description below. And that's it. CPF accrued interest plays a crucial role in ensuring that your retirement savings stays intact. But if you're not aware of how it works, it can affect your cash flow when selling your property. Planning ahead, whether by reducing CPF usage, making voluntary refunds, or refinancing strategically, all of this can help you manage it effectively. If you found this video helpful, leave a comment below with your thoughts or questions. If you enjoyed this video, don't forget to like, share, and subscribe for more practical financial tips. Thanks for watching. I'll see you in the next video.